Interest rates. You hear about them all the time on the news. They affect your loans, your savings, pretty much the entire economy. But what are they, really? And how do they actually work? Well, it's one of the most fundamental concepts in finance, and getting a handle on it is absolutely key to understanding your own money. Okay, let's dive right in.
So here's our game plan for this explainer. We're going to start with the basic definition, then we'll get into why they even exist in the first place, and see how they're calculated. After that, we'll make it real with a mortgage example, zoom out to look at the wider economy, and then wrap it all up with a quick recap. All right, first things first, let's get a crystal clear definition on the table. What exactly are we talking about when we say interest rate? So, in the simplest terms, you can think of an interest rate as the price of using someone else's money. If you're a borrower taking out a loan, it's the fee you pay for that service. But if you're a saver putting money in the bank, it's the reward the bank pays you for letting them use your funds. Now, you've probably seen a couple of different acronyms out there. On the one hand, you have APR, or annual percentage rate. That's what lenders charge you, it's the cost of borrowing. On the other hand, you have APY, or annual percentage yield. That's what you earn on savings. The big difference here is that APY usually includes the power of compounding, and we're definitely going to talk more about that in just a moment. So that brings up a really good question. Why do we have this extra charge in the first place? Why does a lender get to charge you more than the amount you actually borrowed? Well, if you look at it from the lender's side, it really boils down to two main things. First, when they lend you money, they're giving up the use of it. They can't invest it somewhere else and earn a return. Second, and this is a big one, there's always a risk that the borrower just won't be able to pay the loan back. So a higher interest rate is basically their compensation for taking on a bigger risk. Okay, so we know what interest is and why it's a thing, but how is it actually calculated? There are two main ways, and believe me, understanding the difference is crucial because it can have a huge impact on your money over time. Simple interest is, well, simple. It's calculated only on that original amount you borrowed or saved, which is called the principal. But compound interest, that's where things get really interesting. It's calculated on the principal plus any interest you've already earned. People call it interest on interest, and honestly, it is an incredibly powerful force. Just take a look at this table to see how it works. In year one, £1,000 at 3% earns you £30. Simple enough. But in year two, you earn interest on $1,000 and £30. So you get £30 and 90 pence. Then, by year three, you're earning interest on your interest's interest. It might not seem like a big difference at first, but over a few decades, this snowball effect can lead to some really massive growth. Now, theory is one thing, but let's see how this all works in the real world with an example that affects millions of people, a home mortgage. This is where interest rates can have a very, very direct impact on your monthly budget. So let's set up a quick scenario, and we're using some figures here from the Bank of England. Imagine you're borrowing £130,000 and you plan to pay it back over 25 years. A pretty standard situation for a lot of home buyers. Okay, now look at this. See what happens to the monthly payment as the interest rate changes. At a 1.5% rate, your payment is about £520. But if that rate jumps just 1 percentage point to 2.5%, the payment goes up to £583. That's a pretty big increase every single month, and it shows you exactly why even these small shifts in interest rates end up making big headlines. So we've seen the personal impact, right? But these individual rates that you and I see are all connected to the health of the entire national economy. So let's zoom out for a second. The main driver here is a country's central bank, like the Bank of England in the UK or the Federal Reserve in the US. They set one key interest rate, sometimes called the bank rate, and this rate acts like a benchmark for everyone else. It's the rate that commercial banks use to borrow money themselves, so it directly influences all the rates they turn around and offer to us for mortgages, loans, and saving. So why would a central bank want to change its rate? Well, a major reason is to control inflation. Here's the chain reaction. First, the central bank raises its key rate. That makes borrowing more expensive for everybody. In response, people and businesses tend to borrow less and spend less. And with less money chasing the same amount of goods, it becomes a lot harder for businesses to raise their prices. And that helps cool inflation down. All right, we have covered a lot of ground here, from our own savings accounts all the way up to national economic policy. So let's bring it all together and do a quick recap of the most important points. So here are the key takeaways. First, interest is simply the price of money. Second, it's there to pay lenders back for their risk and for giving up the chance to use their own money. Third, never forget the power of compound interest. It's that interest on interest that makes your savings grow so much faster over time. And finally, as we saw with that mortgage example, even tiny changes in interest rates can have a huge effect on your personal finances and the economy as a whole. Understanding this financial force is really the first step toward making more informed decisions with your money. So we'll just leave you with a final thought to consider. Now that you know the mechanics behind all this, how does it change the way you think about your own plans for saving or borrowing in the future?